In the meantime, Fed watchers have been raising their outlook for Fed tightening, forecasting as many as 5 rate hikes for this year. But some new survey data says cooler heads may prevail. Steve Leisman joins us right now with more, and this is the raging debate that's probably driving the markets right now, Steve.
Yeah, and here's another entry in it, our CNBC Flash Fed Survey, Becky. We did it after the Fed meeting to see if the outlook of our respondents changed. Finds they're not as hawkish on rates as market pricing for 5 or more rates, but they are hawkish in another area. We'll get to that in a second. First, among the 38 respondents, the average looks for 3.7 hikes this year. What's that tell you? It shows that 3 hikes are built in, and they're debating a 4th, not a 5th, 6th, or 7th. The average fund rate seen at just 1% this year. Next year, another 3 hikes are built in, with the funds rate rising to 1.8%. Only one respondent sees 5 hikes, and there's little support for a 50 basis point rate hike in March. Douglas Gordon, managing director at Russell Investments, says, while we think that the FOMC's hawkish pivot will sustain hiking through the first half of 2022, we also anticipate that this policy action and its efficacy relative to inflation will allow for a softening of the hawkish stance towards the end and into 2023, towards year end, that is. The outlook for inflation, now running at 7% year over year, is for a decline to 4.2% this year, 2.9 by end of 2023. So the more dovish outlook on rates comes, at least in part, with a belief inflation will come down. But there's another reason. Respondents are looking for more balance sheet runoff than the prior survey. Take a look here. The average looks for the balance sheet to begin running off in July, which was the same, and a total $460 billion this year, up from $380 in the forecast before the meeting. That grows to $930 billion next year, up from $860, and $2.5 trillion in total runoff over 2 years and 8 months. By the way, that total is also lower. It had been 2.8 in the prior survey. Okay, the Fed may eventually prove the more hawkish view on rates to be correct, but it's also possible the Fed will do somewhat less on rate hikes and a bit more on the balance sheet. That's going to determine whether inflation, it will all be determined by whether inflation comes down. So, Becky, the story here is they're leaning more on the balance sheet. And I think you heard that maybe from Esther George yesterday from Kansas City, who wants that course of action.